This particular lecture looks at the actual monetary system in the U.S. I will say that in the textbook, there is a small section on the 2008 recession. You will find that I have pulled that out of this lecture because for my students, I recorded a rather long part for this, and I put that on YouTube as a separate part for those who do not need that longer lecture. I do like to try to keep these to 45 minutes at most. So let's get started. This may seem like a silly question to ask because after all, I see this person, they've got a fancy house, they've got some cars, they get to go on vacation where they want to, they may even own a private jet, even have a racehorse. They have money. Not really. What we would say in economics is that they have wealth, but that's not money because they can't actually take those items and go down to the local grocery store and use the racehorse to get some, I don't know, vegetables. So what is money? Well, money is actually defined as something that has some sort of value that we can exchange it. It has a process of a medium of exchange. And with that as a basic definition of money, then we have to maybe relook at what money is. Because if we go gambling, we could get these coins. And if you play poker or slot machines, you get these dollar gambling coins. And they are basically a type of money. The Chuck E. Cheese, when you go there, you can use this coin as a medium of exchange to play a game. Maybe one day you're lucky and you get a coin which you can exchange for a free drink at your bar. Or perhaps somebody gives you this coin that is representing a Bitcoin, and you could take that and you could go somewhere and exchange this coin for some sort of amount of Bitcoin. What all of these are is that money is really a token. And tokens are basically something that represents value. And it represents what we say intrinsic value. And why we say this is because basically real coins, real dollar bills, as you might want to say, have a concept of what we call fiat money. Meaning is that the money is derived from some sort of government regulation, some sort of law, some sort of decree, because those coins and banknotes on their own really don't have value. Meaning is that what can I really do with that dollar bill except for maybe light it to help start a fire? The only reason it has value is because someone will use it as a medium of exchange. Now, there is something called commodity money, and commodity money actually has value on its own. So a gold coin, and we used to use gold coins as a medium of money, and they had value because you could melt down that gold and make jewelry out of it. But that isn't the only type of money, that commodity money, we've used over the ages. It was pretty common to use cigarettes at one point in World War II as a commodity money. Beaver pelts were commodity money because each one of those items had value on their own, meaning is that I could smoke the cigarette if I wanted to. I could use the beaver pelts as clothing if I want to, but I could also use it as a medium of exchange. So today, most of the money that you look at, or most of the money that you use, is actually what we call fiat money. It has value because basically there's been a government regulation decree of some sort, which is also why it can be a problem, because if for some reason that government goes under or the government says that has no more value anymore, then all the stuff you have is basically valueless. Now, one of the questions I ask every once in a while is, can basically a state have money? And the answer is, yeah, they can't make coins, but they can make paper money. And there are some cities who have had their own money and do. Right now, the Detroit has kind of an interesting little money that you can get there. Poconos, I believe, have got some, again, paper money that you can use in exchange within the Poconos. So when we talk about money, we have to understand that what we hold in our hands, they're more like tokens, and they have value because we can exchange those tokens for another thing. So officially in psychology, we would say that there are things called primary goods, and those are things that would basically keep you alive, like food, water, shelter. And then there's secondary, and money falls into secondary. Secondaries are important because they can help us get primary goods. So money is important, but we need to make sure, as far as talking about economics, that we understand the difference between money and wealth. Money has three basic functions in an economic society. The first one, and maybe the most valuable, is that it's a storage for value. Basically, we can use money to store value from today to be able to use that value tomorrow. Now, let's go over a couple of definitions also as we're talking about the storage of value. And the first one is wealth. We began this lecture with showing a picture of this nice lady who's got all this stuff, and we said she didn't really have money, but she had wealth. Well, wealth is basically the total economic value of all the things that a person owns or has control of. That's both money and non-monetary assets. So then the question is, what's an asset? Well, an asset is basically any type of a resource that you own or control that has some sort of economic value, but there's also an expectation that in the future it will provide some sort of benefit. Now that benefit has to be an economic benefit, and that's one of the things that's always kind of hard sometimes to understand about assets. If the asset doesn't have an economic value in the future, then it's not really considered an asset as far as economics is concerned. So if I have, I don't know, a little painting that my 5-year-old did. Now, that has value to me because it reminds me of him being 5 and all kinds of fun things. But the question is could I go out to a store and use that or make money with that? Beanie Babies. At one point, people were buying lots and lots of Beanie Babies. The thing is that today you could go out online and you could try to sell your Beanie Babies, but would you make basically more than you bought them for? And in most cases, the answer is going to be no. So monetary or money assets are pretty easy to figure out. That's the cash that you have in hand. Non-monetary assets, though, is pretty much everything else. So a stock, a bond, the houses that you buy over time, inventory that a business has, even some artwork is non-monetary assets. Now, I just said my 5-year-old's painting is not an asset, but if I had a Rembrandt, now that would be an asset. I could turn around and sell that, and I keep it because I think in the future it's going to have some sort of value. Now remember, just because I think it's going to have value doesn't mean that it's an asset. So if I buy a whole bunch of, let's say, Star Wars toys, because I think one day that I'm going to be able to sell these for a lot more money, they don't really have economic value unless I can sell them or even get any money for them. Which brings us then to the last kind of concept, which is liquidity. Now, liquidity is used in economics, it's used in accounting, it's used in everything. Basically, liquidity just simply says is how fast can we take that non-monetary asset and convert it to money, or officially the medium of exchange that society uses. Now, the faster an asset can be converted, the more liquid we would say it is. So, as an example, I could take my stocks and pretty much sell my stocks 24 hours a day. So it's a pretty liquid asset. Now, I may not get the money I want for the stock, but I could go and I could quickly liquidate the asset. Now, a house is going to be a little harder to liquidate, so it's not going to be as liquid, let's say, as a stock is. And then my Rembrandt art, well, that might be even a little bit harder and a little bit longer than even my house to sell. So liquidity is always important. Now, most people who have wealth will try to balance between money that they have and non-monetary assets and how liquid or unliquid that asset is. So the storage of value is one of these big things that money has for us. And that's because it's a medium of exchange within society. We're exchanging that value that I have right now, and you're accepting that exchange with this token. This token, this fiat money, basically you're accepting and saying that in the future, if I have this, I'm going to be able to use this for something else that's of value. Now remember, I talked about primary and secondary reinforcers. And those primaries are things like food, water, the things that we have to basically live and survive. And so money is being a secondary because I can use it to later on purchase things that I need to survive. So it becomes this medium of exchange, but even more importantly, it becomes a medium of exchange within a society. And so a society accepts that exchange. Now, if for some reason we suddenly say we're not going to accept that money anymore, we're not going to accept that exchange, then it becomes devalued. It has no value because I can't store value in it, and I can't use it as a medium of exchange for that value or that purchasing power. And finally, it gives us a unit of measurement, a unit of account officially. Because we use money, we can then define the value of each item in a common language. So I can go to a store and I can see a price of an apple. I can go to the store and I can see the price of shampoo because I understand the unit that they're talking about, because there's a common knowledge within that society how much that represents. I'm able to communicate with the store, and the store is able to communicate with me. Now, anybody who's ever gone to a foreign country can find that, not understanding the unit of account can be really difficult. I can remember traveling to countries that had no coins. They only had paper money. And that was really difficult for me to understand that some of this paper money was, equal to a penny, because for us, we have coins here in the United States. And so in my own head, if there was a piece of paper, it had to be something like a dollar bill. So I didn't know what the unit of account was. It made it a little bit more difficult. I learned it, of course, very quickly, but it gives you a great example of the function of money. It's used as sort of a communication tool. It's our measurement tool, our yardstick, you might want to say. So if the item that is being used doesn't have these three things, then it's not money. It has to have these three things in order to function as money within a society. Let's move on. One of the things that's important in any economy is to understand how much money is actually out there, how much money is out in the supply. And that helps us make decisions on policy. So at least within the United States, we break most of our money supply down into two groups of money, M1 and M2. Now, M2 money includes all of M1 money. It then adds some more stuff. So M1 money, as you can read, and that's the write-up directly from the Federal Reserve, who's the person who counts and determines all this, is our most liquid money. And remember, liquidity means sort of cash, so currency. Now, demand deposits, those are account deposits where we can access that money by writing a check or using your debit card. Basically, it's money held in a bank or held in some sort of a demand deposit where I can take that money out instantly. Traveler's checks are basically a demand deposit of type. I mean, that is like currency. And there are other types of accounts like this. Now, M2 is money that is available to you, might take just a little bit longer to liquefy it. So a savings deposit, you would think, well, isn't that the same as a demand deposit? Not really, because I can't write a check against my savings. That's why we have separate savings accounts and checking accounts. And the small time deposits, those are things like CDs, mutual funds, a few other minor categories. Now you also see over there the words ATS. ATS is just talking about automatic transfer systems. So if you have a direct deposit, that's an ATS. If you have automatic payments to, let's say, the light company, the utility company, that's ATS. There's actually money in that system going back and forth. And now is a type of account that businesses often have. They're sort of like a very fancy checking account, and that's about all we really need to get into for people this level. Now, the Federal Reserve does measure this, and they put this out all the time, how much money is out there. Again, you can go to the federalreserve.gov and find a lot of this information, or just put it in Google and it will bring up the website. Now, the money that you're seeing down there, because mostly people tend to look at that right away, that is in billions. Understand, it's in billions. Now, notice that they do M1 money, they do M2 money, but they also do IRAs, individual retirements, and kiosk accounts, which are sort of like an individual retirement account. But they're tracking how much money is out there in the system. We need to know that so that we can make decisions. So if you ever hear about M1 money and M2 money, that's all they're talking about. M1 is the most liquid. M2 includes all the M1 money plus a little bit more. So in 1907, we had a lot of banks that basically failed. And when those banks failed, the U.S. government said, we need a Federal Reserve system. And so the Fed was created in 1913. Now, the Fed has basically kind of three entities to it. One, it's the U.S. central bank. If we have a fiat system of money, which we have, we need a federal system. And there are three sort of key entities that are part of the Fed. The first is the Board of Governors. Now, the Board of Governors are appointed for 14-year terms. In fact, they cannot be dismissed by the president. The most important person, and they're rotating, by the way, not everybody gets appointed the same year. They get appointed like 2 this year, 2 that year, that kind of thing. Now, we want them on long-term basis because we don't want them thinking short-term policies. We want them thinking long-term policies. Now, the most important position amongst the governors is basically the chairman. And so this is a picture of the last 4 chairmen that we have had. Now, the current chairman, as of recording this, is Jerome Powell. He was confirmed in 2018. The chairman of the board has to be confirmed by the Senate. Now, he has a 14-year term, but as the chair, he's appointed for 4 years. Now, he can be reappointed and over again. Alan Greenspan was appointed and was the second longest chairperson we've ever had. So as of recording this, Jerome Powell is the current Federal Reserve chair, and they're pretty powerful as far as what they do. Now, the Board of Governors, they'll come together to make lots of decisions, but there's also 12 Federal Reserve banks, and they are staggered all around the country. Now, if you'll notice, there's kind of a lot more in the East because, of course, the Federal Reserve was created more in the East when it was first made. But these Federal Reserve banks each have a person who's in charge of that. When they come together, this is called the Federal Reserve Open Market Committee. So we have the Board of Governors, but we also have all the Federal Reserve banks. Now, what's interesting is that each president of the Federal Reserve banks, they'll all come to this big meeting that occurs, but only 5 of them get to vote. The other ones just get to sit around and listen. However, New York always gets to vote. They always have a vote on there. And that's because the New York bank is basically the bank that makes the decisions for the United States. If they're going to be the ones who's going to print the money or take the money or whatever's going to happen, basically New York is the one who's going to apply it because it's our sort of first and biggest. But there are 5 functions, as you can see, that the Federal Reserve does. And one of the biggest functions is basically creating monetary policy. Now, monetary policy and the other policies are slightly different. So monetary policy is anything that the central bank has to do to try to keep the economy going, to maximize employment, to keep prices stable. Where fiscal policy is about basically the collecting and distribution of money. So let's take a look a little bit more at the difference between monetary policy and fiscal policy. So as you'll notice, I get a lot of stuff right from the Federal Reserve. In this case, it's from the Federal Reserve Bank of Atlanta. So what's the difference between fiscal policy and monetary policy? Well, one of the big things is who runs it. Basically, fiscal policy comes out of the government, the president, the Congress, and you can think about this even on the state level. It's going to be basically your state senate who's going to do it. Whereas monetary policy comes out of that Federal Open Market Committee, where we talked about that there are the rotating votes, the New York person, the Board of Governors. Those members are the ones who are going to make the decisions. So their decisions are made by 2 different groups. Now, each one has different tools. So the government, it can control spending and tax rates. That's its basic policies or tools, you might want to say, for its fiscal policies. Where with monetary policies, the Federal Reserve can buy and sell bonds, because remember, bonds, U.S. government bonds, T-bills, and things like that, they'll decide those type of things. They also are what we call the bank of last resort, meaning is that if another bank is having trouble, they can't borrow money from the Federal Reserve. So in one way, the Federal Reserve sort of sets interest rates, because what they charge to the local bank to borrow money, the local bank, of course, will then increase or decrease the interest rates depending on the borrowing that they get. So they also make policy about what we call reserve requirements. And that means that if I go to a bank and I put $100 into that bank has got to hold some of that money. It can't lend all of it out. If it lends all of it out, then what happens if I want to go and get my money? So they'll make the reserve requirements, and there's a lot that will depend on the bank and things like that. And that's for a banking class, but that's one of the things that they control. The other thing that we want to look at is, what type of policies could basically the government put in place if we want to stabilize the economy because maybe inflation is going high, versus what type of monetary policies could the Fed put in to do basically the same thing. So as we can see, taxes are going to be the big things on the fiscal policy side, whereas for the government, if they want to basically help stabilize because of inflation, they're going to look at an increase in reserve requirements. They're going to increase the interest rates. They're going to have more discount rates, and they're going to be looking at, how does all this work together? And pretty much over the years, because we've done this enough, we can see what the final results are. But sometimes we don't want contractionary, meaning is that we don't want interest rates to go up. We don't want inflation to go up. In fact, maybe we do want inflation to go up. We want to grow the economy. So instead of contracting, we want to grow. In that case, for expansionary, we're going to see sort of the opposite. Now, what's kind of interesting as far as monetary policies are concerned, you'll notice they'll decrease interest on reserves. Now, decreasing the interest means that consumers will borrow more money, and thus they will spend more. Businesses will borrow more money and thus spend more. And the thought is that that would increase demand. So we'd see a shift to the right in that demand curve we talked about. And that should also increase things like GDP, but it also will increase price levels. But it should increase employment because we're increasing real GDP. On the government side, taxes and government spending are going to be the two ways. So part of like what policy we're going to follow would also depend on how you see the economy. That's one thing that we don't talk too much about, is that one person can see the economy is sort of expansionary, and one can see that we need to contract. And so that isn't always an agreement. But remember, from the very first lecture, we said that for economics, the job of an economist is just to simply tell you the options. They don't make the decisions. And if everything goes according to plan, what we're going to try to do is keep sort of this long run aggregate supply sort of where we think potential real GDP is. And depending on what GDP actually is, will let us know whether or not we need to have some sort of a plan for a recession, or do we have to have a plan for inflation? So all of these kind of come together, and that helps you understand a little bit about the fiscal versus monetary policies. And also hopefully, when you have questions and you're listening to the talking heads on TV, go to the Federal Reserve when it comes to monetary policies, and they've got really good information out there. So you can self-educate even beyond the simple economics class we have here to allow you to understand what the long-term and short-term effects are going to be of both these fiscal and monetary policies. The Great Recession of 2008 is something we're going to examine. But before we can examine it, we need to go through basically how banks influence the money supply. Now, I have those two definitions for money and wealth that we talked about earlier. But this is about money. Remember, it's not wealth. Wealth is the value of all the assets that a person owns. Money is basically an economic unit that we use to make exchanges. So we're going to get rid of wealth because we're talking about money and the money supply, the M1, M2. So remember Marco over here. Marco had some money and he went and put it in the bank. So according to basically records, what we have is a fractional reserve banking system. Basically, when he puts that money in the bank isn't going to keep all $100 constantly in the bank for him anytime he wants to go and get it. Now, instead, they rely on something called a balance sheet. Basically, he's going to have some assets, the bank, and they're going to have some liabilities. Now, on a balance sheet, your assets must equal your liabilities. So they have basically a deposit of $100 from Marco, and that's a liability for the bank because at any point, Marco could come back to this institution and say he wants his $100. In this case, the bank is going to hold all $100 as a reserve. So reserve is just simply any money that's been collected but hasn't been loaned out. Now, in this situation, which would be very, very simplistic, the problem is how is the bank going to make any money? It's not. It's only going to make money is if it loans money. What money does it loan? It loans out the reserves. So what happens is that a bank only has to hold a fraction of the money that it has for deposits, and that's called the reserve ratio. So in the example we're going to have, you're going to see that it has a reserve ratio of 1/10 or 10%. Now the reserve requirement is the amount that the Fed says is the least amount that a bank has to keep. Now a bank can keep more than that, but it has to keep the least. So here's good old Ramona. You may have remembered her from another one. She goes to the bank and she gets a loan, and her loan is going to be for $90. So now the bank has on reserve $10 because 10% is what they had to keep, $1 out of every $10, so 1/10 of the money. And she gets this loan of $90. Notice that the assets still add up to $100. So we're doing pretty good here. But when the bank basically is a fraction holder of deposit, it can actually create money. So how does it create money? Well, remember, money is an economic unit. It's not wealth. So Ramona is going to go and take this money and she's going to go to a corporate bank, let's say, and she's going to open up something in a corporate bank for her business, and she's going to put her money in there. Now, that bank is going to loan the money out to Rudy. And you might have remembered Rudy from earlier. He was a restaurateur. So this bank's balance sheet is going to look like this. Now, they only have a liability of $90 because remember, Ramona only had $90 to put in the bank. But they also keep 10%, so $9. So the most that Rudy could get for a loan is $81. And we can keep going and going and going and find out basically that after a while, this money is sort of being created because we're being able to use it. That brings us to a concept called the money multiplier. Now that's the amount of money the banking system generates with every dollar in reserve. So it's about how much is in reserve. So what we know is that the multiplier is basically the reciprocal of the reserve ratio. So our reserve ratio was 1/10 in this example, and basically it would depend on the Fed and if the bank wants to hold more money, but most banks only hold what the Federal Reserve says they have to hold. So if we look at this particular one, the example we have above here, we have a deposit of $100. We've got a reserve ratio of 1/10. So our money multiplier is 10. Remember, it's the reciprocal. So basically what the number on the bottom is. So we take our deposits, we multiply it times 10, and we got $1,000. So that means that for every $100 that's deposited, basically it's going to create $1,000 worth of use. If we have a multiple of 20, let's say, we're going to see that it's $2,000. And if we have a multiple of 5, basically we're going to only create $500. So what we do know is that the higher the reserve ratio, the less money there is to loan when it comes to a small money multiplier. Now, this is one reason why we're always looking at interest rates, but we're also looking at what the Fed sets as a monetary policy for basically the reserve ratio. Not something you hear all the time, but something that people do talk about because the question is the bank holding enough money in reserve for their depositors? Basically, does their liability and their assets balance out? Because they have to. So we're going to look at this a little bit more detailed as we begin to talk about what happened in 2008. The last slide showed you a very unrealistic balance sheet. And to be honest, this is a pretty unrealistic balance sheet too, but it's going to help us understand a little bit more about what happened in 2008. if we have this nice little bank here, the banks are going to be getting money in multiple ways. They're going to, of course, have their deposits, but they also may borrow money themselves to help do things within their company. There's also going to be something called capital or owner's equity or stakeholders' equity. And basically all equity is the amount of money that would be left over after we sell all of our assets, assuming we liquidate the company, and after we pay our deposits and after we pay our debts, what money would be left to the people who own the business. And that's what equity is. Now, equity has a couple of different names. We have shareholders' equity, and that's for publicly traded companies. So if you own stock in something that's a publicly traded company, you have shareholders' equity. If a business is owned by a private person or a group of people, so our favorite grocery store here in Florida, Publix, is a privately owned business. Mars Candy Bars is privately owned. They have what they call owner's equity because just the few people who own the company have the equity. But we also tend to use the word capital or company's capital also interchangeably there. And those going into finance or into accounting, you'll learn when you use each one of those words in a more specific way. But for now, you're going to see me use capital and equity just to keep things a little bit easier for those other folks. Now, in order for a business to grow, they quite often have to use something called leverage. Basically, they borrow money to help them supplement their income to build something bigger and better. So you have used leverage if you bought a house. You borrowed money to increase your investments, and a house is an investment. What we're looking for is what we call a leverage ratio. That's basically the ratio of the assets to basically the capital equity, what they put into the business versus what they have. So looking at this little scenario here, what we have is total assets of $1,000. We have capital of 50. And so our leverage is going to be 20. This means that for every dollar of capital, there's $20 in assets. Or another way to look at this, for every $20 of assets, $19 has come through borrowing. So we would say that the leverage ratio for this company is 20. So why would a company want to borrow money? Well, it's pretty simple. Let's say these securities went up by $50. That means that we've had a 5% increase in our net worth. What that also means is that not only did our securities go up by $50, but our capital went up by $50 because remember, assets have to equal liabilities. And since our deposits and our debts didn't go up because we didn't borrow money to do this, we've doubled our money. Basically, we had a 100% return. And for an owner, that's really nice. I like to have lots of that. Not only that, but now for every dollar of capital, I've got $10.50. And basically, my leverage has actually come down. This is good. We like this. But remember, what goes up can also go down. Let's say that instead of going up by $50, it actually went down by $50. It went down by 5%. Now, if you'll notice that our securities is 150, but our capital, our equity is 0. And when we see a situation where the capital equity gets to be 0, or even less than that, we basically say that the business is now insolvent. Why? Because they have more debt than they have assets. They can't pay everything off. So their deposits and their debt is equal to. Now, once in a while, when you see a business like this, what they'll do is they'll sell everything off. And if a business has got 2 or 3 different versions of itself, meaning it's got like Kmart and Sears were one company, it might sell all of Kmart off hoping to hold Sears because they would have separate balance sheets. This is going to be important to understand that while we may make money by leveraging going up, we also have the potential if that leveraging ratio gets too high, it can kill a company. So let's take a look at that. In 2008, we had something called the Great Recession. It was not a depression, but it was a Great Recession. If you need more information on this and your class goes into more detail, please do check out the separate lecture I have on this. In my class, it is incorporated into this lecture. It's about 16 minutes, but for many people on YouTube, you do not need that information. So we're going to keep moving on. So you've just heard about the Great Recession of 2008, and now it's time to wake back up. Hopefully you found that a little bit interesting, but one of the things you may have kind of noticed is that I didn't really talk about the Federal Reserve when I talked about the Great Recession. And in an odd way, the Federal Reserve actually doesn't have as much power as you think to actually control things like the money supply. Now, it does have some tools to control the money supply, but these tools are indirect, meaning that it isn't out there directly having control. So let's look at the tools that the Fed does have that can help control the monetary supply. And the first one is that it can influence the quantity of reserves. Now, it does this through the open market operations. That's one of the biggest ways it does this. And that's because, remember, it buys and sells government bonds. And so when it sells government bonds or buys government bonds, it's influencing the amount of money that's out there. So if there's too much money out there, it could call back, or it could go back and buy some of its bonds, which would reduce the amount of money that's in the system. If it thinks that there should be more money in the system, it's going to sell bonds. And so we hear this all the time, that the government is buying back or we're selling bonds. The other thing that it can do, and that it does, is that it lends to banks. It is the lender, you might want to say, to a commercial bank. How does a commercial bank get more money than its deposits if it needs it? Well, it's because the Federal Reserve will lend. Now, this is called the discounted rate. The rate that you often hear is the prime rate. The prime rate is very important, but the discounted rate is less than the prime. Why? Because if a bank has to borrow money at the prime rate, it's never going to make any money. And we have to keep remembering banks are for-profit institutions. So if I'm the bank and I go borrow money from the Fed at 1%, I want to be able to turn around and loan that money out at, well, let's say 3%. So now the difference between these two is 2%. That 2% is what the bank is going to make off of that loan. Now, it may not be profit, because remember, the bank still has to pay back the Fed, but it also has to pay its employees and its stockholders and all kinds of other things. So it needs a discounted rate. And by setting that discounting rate, the Fed is basically helping to control how much money basically banks want to borrow. So this also, though, has this alternative effect. And one of the biggest ones is that it gives stability to the financial markets of the United States. Now, most central banking systems really do this in countries, but this stability allows people to have a comfort level of using our economy system, of using our monetary system. Because if we think a bank is really going to go under, we know that the Federal Reserve can step in. And if it's a bank that looks like it can do okay, then it might increase the lending to that bank to help it get through that small time period. One of the things that banks are always worried about is something called a run on the bank. A run on the bank is where a lot of people basically go and start withdrawing money from the bank. Now remember, the bank doesn't hold your entire deposit. So if you deposit $100,000 and you go get $100,000, you're expecting to be able to walk out with $100,000. Now, the truth is that most of your little local banks aren't holding that much cash on hand. They may need 24 hours to get that much cash. But if you write a check or something else, you expect to be able to use that money because they're having it. Well, that's okay if only one person does it, but if a lot of people start doing it, or we get what we call a run on the bank and the customers all start to run to get money, remember the bank doesn't have enough money on hand. Now, we know we saw runs on banks in the Great Depression. But we've also seen runs on banks, especially regional banks, after natural disasters. So after Hurricane Katrina, a lot of people needed cash because basically charge cards weren't working and cash was king. It always worked. And so a regional bank may get a quick run on money because of the need of that community. So the federal bank can come in and perhaps loan the bank some money for a little while until things stabilize out, and then basically the bank can pay back that money, which brings us then to basically influencing that reserve ratio that becomes so important. So it can do this by changing the reserve requirements. Now remember, the reserve is just that minimum amount that a bank has to hold in the Fed to cover the deposits. So if it increases that reserve ratio, then there's less money in the system. So if we have that $100,000 bank and it's holding 10%, so 10,000, remember it's $90,000 out in the system. But if it has to hold 20%, it only has $80,000 to loan out. So if we increase the reserve, we have less money in the system, and if we decrease the reserve, there's more money out there in the system. But the truth is that the Fed rarely changes this reserve amount. It makes for big problems within the system if the reserve amount is changed too much. However, I will say that after the 2008 Great Recession, a lot of the reserves were changed. It was changed because we found many banks didn't have enough money basically set aside if there had been sort of a semi-run on banks. Now, the other thing that is interesting is after the 2008 Great Recession, the reserves started paying interest on those reserves. Until then, basically, when a bank put money in the reserve, which it had to do, it received no interest. So it didn't want to put money in the reserve. It basically it didn't make any money, but it could also be seen almost as losing money because of inflation. But when the reserve started paying interest on that, banks not only want to put money in the reserve, but they actually increase the amount of money they put in the reserve. Many banks today actually hold more money in the reserve than they're required to hold in the reserve, basically as a safety fund. So the higher the reserve, though, the lower the multiple. Now remember, the multiple is how much money $1 can make out there as far as lending and loaning is concerned. And the lower the reserve, the higher the multiple, because the less money is out of the system. So all of these are great and fine, but we also have the problem that there are two things that basically the Fed doesn't control. The first one is it doesn't control how much money people are going to choose to deposit in the bank. And remember, all of this basically is based on how much deposit a bank has in the first place in order to put money in and out of the system. The other thing it doesn't control is it doesn't control how much a bank decides to lend, and how much house do you want? It may or may not lend most or little of its capital, and different banks have different requirements of how much money it may have. But the Fed doesn't control either one of these, and as you saw earlier in this lecture, these two things really help control the flow of money within our system. Again, if you need more information on the 2008 Great Recession, if it's something your teacher is going to cover in more detail, you might want to pick up that separate lecture that I have posted. It actually, for my class, is part of this lecture, but I know that many people don't want to listen to 16 minutes on the Great Recession if you don't need to. So I hope this lecture helped you. If you want to check out some other lectures, check out the economics playlist. Until next time, keep learning.